My name is LIZA NOVALIA from the Management Department. Today, I will present a topic titled, Theories and Principles of Behavior in Accounting. In this presentation, I will explain how human behavior influences accounting decisions, financial reporting, and the use of accounting information in organizations. 1. Introduction. Accounting is not merely a technical process of recording and reporting financial data. It also involves human behavior. The actions, judgments, and decisions of individuals and organizations can significantly impact accounting outcomes. Understanding behavioral theories and principles helps us interpret how accounting information is prepared, perceived, and used in decision-making processes. 2. Scope of behavioral accounting. Behavioral accounting studies the psychological and behavioral aspects that influence accounting practices. It focuses on two main groups: preparers of financial statements, e.g., accountants, auditors, managers, users of financial statements, e.g., investors, creditors, regulators. The goal is to understand how perception, motivation, ethics, and cognitive biases shape accounting behavior. 3. Key behavioral theories in accounting. A. Agency theory. Agency theory explains the relationship between principals, owners, and agents, managers. Because they may have different objectives, conflicts of interest can occur. For example, managers may present financial reports that favor themselves, highlighting the need for proper controls and incentive systems. B. Prospect theory developed by Kahneman and Tversky. This theory describes how people make decisions under risk. It shows that people are more sensitive to losses than to gains. In accounting, this explains why individuals tend to be conservative, preferring to delay recognizing uncertain profits. C. Cognitive dissonance theory. This theory suggests that people experience discomfort when facing information that conflicts with their existing beliefs. In accounting, an auditor might ignore evidence that contradicts their prior judgment, affecting the objectivity of financial assessments. D. Theory of planned behavior. According to this theory, individual behavior is driven by intentions, which are influenced by attitude toward the behavior, subjective norms, social pressure, perceived behavioral control. It helps explain why accountants comply or fail to comply with ethical standards. E. Positive accounting theory. PAT focuses on explaining actual accounting practices rather than prescribing what should be done. It assumes that managers act in their own self-interest and choose accounting methods that benefit them, for example, to increase bonuses or meet debt covenants. 4. Behavioral principles in accounting. Materiality. Information is considered material if it affects decision-making, but the perception of materiality can vary between individuals. Relevance and reliability. A balance must be maintained between decision usefulness and trustworthy representation. Cognitive biases, including overconfidence, anchoring, relying too much on initial information, and framing, influence of how information is presented. Ethical conduct. Accounting relies heavily on integrity, trust, and professional ethics. 5. Real-world applications. Case examples. Enron and WorldCom scandals demonstrate how management pressure and personal incentives can lead to fraudulent reporting. Auditor independence. Personal relationships with clients may reduce auditors' objectivity. Earnings management. Subtle manipulation of financial results to meet targets, often driven by bonus plans or stock performance. 6. Implications for accounting practice. Internal control systems should be designed with behavioral considerations in mind. Ethical training and awareness are essential in accounting education. Financial communication should consider how users perceive and interpret information. Accountants and auditors must be aware of their own biases when making judgments. 7. Conclusion. Accounting is not just about numbers, it is about people. Understanding the theories and principles of behavior in accounting provides deeper insight into how decisions are made and how financial information is shaped. By integrating behavioral understanding, accounting practices can be improved in terms of ethics, reliability, and relevance. 8. References. Jensen, M. and Meckling, W. 1976. Theory of the firm, managerial behavior, agency costs and ownership structure. Kahneman, D. and Tversky, A. 1979. Prospect Theory. An Analysis of Decision Under Risk. Eisen, I. 1991. The Theory of Planned Behavior. Watts, R. and Zimmerman, J. 1986. Positive Accounting Theory.